What does the future hold for the U.S. real estate market in 2024? That's the question on everyone's mind as we step into this new year. The echoes of a challenging 2023 still linger, with high mortgage rates and median home prices that soared past the $400,000 mark. But as we look ahead, there's a glimmer of hope for potential home buyers. Experts predict that we may see softer prices in certain regions across the country. This prediction comes with the expectation that the Federal Reserve will put a halt to raising interest rates, indirectly influencing the mortgage rates that have been a significant factor in the 2023 housing market. However, it's not all smooth sailing. The affordability challenge persists, a result of low inventory and a high demand that far outpaces the supply. For a true recovery in the housing market to occur, we need to see an increase in homes for sale and a gradual cooling off of interest rates. Yet, amidst these challenges, there are signs of potential turnarounds. The Mortgage Bankers Association anticipates an increase in mortgage origination volume this year. Home builder outlook is improving, and new single-family building permits have seen an uptick. Existing home sales even saw a slight increase in November 2023, hinting at the possibility of a more positive 2024. However, it's important to note that the supply of existing homes for sale isn't expected to see a significant increase until mortgage rates drop back into the low 5% range. And while resale inventory remains low, home prices are still substantially higher compared to what we saw in February 2020. In response to these high prices and mortgage rates, many consumers have decided to press pause on their home buying plans. So as we venture further into 2024, we're left wondering, will there be improvements in affordability? Or will the dream of owning a home continue to elude many? Only time will tell. As we venture further into 2024, many factors will influence the U.S. real estate market. Let's delve deeper into some of them. Mortgage rates play a crucial role in the housing market, but how exactly are they influencing the market this year? In the complex world of real estate, mortgage rates are like the hidden rudder steering the ship. They might be out of sight, but their influence is undeniably powerful. This year, the relationship between mortgage rates and the housing market has been particularly interesting. During the challenging housing market of the previous year, mortgage rates were high, and median home prices soared beyond $400,000. But here's where it gets intriguing. Mortgage rates have been on a downward trajectory recently, a trend that has sparked a glimmer of hope for potential buyers. These declining rates have led to a decrease in mortgage applications, but as the rates continue to soften, the Mortgage Bankers Association predicts an upswing in mortgage origination volume this year. That's right, more people are expected to take out mortgages, a signal that the real estate market might be gearing up for a turnaround. But, just like a coin, there's another side to this story. While the Federal Reserve is expected to cease their interest rate hikes, which could indirectly affect mortgage rates, affordability issues persist. The culprit? A combination of low inventory and pent-up demand. For a housing recovery to truly take place, there needs to be an increase in homes for sale, and interest rates need to cool off gradually. In areas where demand outpaces supply, the existing stock of homes for sale is not expected to increase significantly until mortgage rates fall back to the low 5% range. This imbalance could potentially keep home prices high and continue to challenge affordability. But let's not forget the silver lining. The outlook for home builders is improving, and the number of new single-family building permits has increased. This could eventually lead to an increase in inventory, easing some of the pressure on home prices. In conclusion, while mortgage rates have started to decline, their impact on the housing market is still significant. Affordability issues persist, and the recovery of the market depends on a delicate balance of factors, including the availability of homes for sale and the cooling off of interest rates. It's clear that mortgage rates will continue to be a significant factor in the housing market this year. Although we discuss residential real estate often, the commercial sector deserves as much attention. So, what's the scenario? The big news is that America's commercial real estate market is teetering. As per a Business Insider article, experts are hinting at a possible financial catastrophe in the U.S.'s debt-ridden commercial real estate sector. This issue has been on the radar since the Silicon Valley Bank collapse in early 2023, which unveiled a whopping $1.5 trillion of debt nearing maturity. The high interest rates have only worsened the situation, sending distress signals throughout the industry. These combined factors lead to forecasts of increased defaults and delinquencies. A drop of another 20% is expected in office property prices by 2024, with the U.S. office market's peak-to-trough decline predicted to be 43%. Not just property owners are worried, so are the banks. It is estimated that banks might face losses to the tune of $160 billion from commercial real estate. Some even predict these losses to reach $250 billion. Major banks have started unloading risky assets from their commercial real estate portfolios. Approximately 14% of commercial real estate properties are in negative equity, and default rates on commercial real estate loans might reach up to 20%. The office loan delinquency rate has hit 5% this year. The total commercial real estate debt increased by $37 billion in the last quarter. The Treasury Department even foresees that office buildings might be left deserted with the work-from-home trends persisting, resembling the fate of the zombie malls during the pandemic. The commercial real estate sector is undoubtedly undergoing testing times, but its response will be pivotal. Employment trends significantly affect the real estate market. Let's understand how. The rise and fall of employment rates are intrinsically tied to the health of the housing market. When job security is high and unemployment rates are low, people are more likely to invest in real estate. Conversely, when job security is low and unemployment rates are high, people are less likely to make such investments. Let's consider the current global housing market slowdown, as reported by CNN. Rising interest rates are a crucial factor in this downturn, but unemployment levels are equally important. As joblessness increases, forced sales and foreclosures also rise. This trend creates a cyclic effect, as these forced sales often lead to a further decline in house prices. Now, let's look at the case of Helen of Troy, a consumer goods company that recently announced layoffs of 10% of its staff. This is a significant move that reflects the economic uncertainty and sluggish demand plaguing many sectors. When companies lay off employees, the ripple effects are felt in the housing market too. With less income, these employees may find it difficult to keep up with mortgage payments, or may have to delay their home buying plans. In addition to layoffs, the decline in job vacancies, as reported in the same CNN article, also impacts the housing market. With fewer job opportunities, people may be hesitant to buy a home or may have to settle for a less expensive property. These employment trends have a profound impact on consumer purchasing power. When people are uncertain about their job security or their income, they are less likely to take on large financial commitments like buying a home. This decrease in demand can lead to a slowdown in the housing market, with fewer homes being sold and house prices potentially falling. In conclusion, employment trends and the overall health of the job market play a crucial role in shaping the real estate market. As we navigate through 2024, these trends will undoubtedly weigh heavily on the real estate market this year.